G'day and welcome to the Investor Motivation YouTube channel and also podcast. We're absolutely delighted to have Chris Wheldon, who's Portfolio Manager with Magellan Financial Group with us. And we're just going to have a good general chat about the Magellan High Conviction Fund, which he's co-manager of with Hamish Douglas from Magellan. Welcome, Chris.
Hi, Rob. Pleasure to be here.
Thank you, and enjoying working from home.
Getting used to it. Yeah, we've sort of been in this environment now for 10 weeks or so, and it is genuinely working well.
Fantastic. Obviously, the technology we're using is having a huge impact on the efficiencies of our business, and obviously a lot of the technology we're using are businesses based within the portfolio. So we're about to go through a bit of that as we have the discussion. But I think we should kick off with having a chat about the High Conviction Fund and what you guys as fund managers and managing billions of dollars, what you guys have done in recent times given the COVID outbreak and the subsequent share market crash and partial recovery that we've seen of late. Yeah, so what's your thoughts? What have you done in the short term?
So if I think back to the start of the year, obviously the start of 2020 looks very different to the conditions we find ourselves in today. But at the start of the year, we were running, close to fully invested, quote unquote risk on portfolios.
Yeah.
But that shifted quite meaningfully in March as we really started to digest and connect the dots around everything that's going on with coronavirus, and that we expected at the time associated with coronavirus. And thinking back, it was sort of early March, we shifted to a much more defensive posture across all of our portfolios. We increased cash very meaningfully in the Global Fund, in the High Conviction Fund. Cash went from about 5% at the start of March, and we finished March at about 28%. So a very meaningful increase in cash in a very short amount of time. And to get there, we exited two positions, and we'll start there. In the High Conviction Fund, we exited LVMH and we exited Yum Brands. And the rationale for each of those, LVMH was just recognizing, and we can come back, Rob, and talk through some of the macro views that we have, but just to sort of summarize, we're still very cautious in terms of the macro cycle that's ahead of us here. Yes. And we just recognize that LVMH, a wonderful business with a portfolio of great luxury brands, but it's a cyclical business. It's exposed to economic developments, and the profile for that business in the environment in which we now find ourselves just isn't as attractive. And the return profile relative to the risks just weren't as attractive. So we decided to exit LVMH. We also exited Yum Brands for different reasons. Yum was more around question marks we had just in the short term around their funding profile and their balance sheet, and whether they were at risk of tripping a couple of covenants, which could have resulted in a dilutionary or an expensive capital raise. And we just didn't want to expose clients to that risk in the short term. So we decided to exit that position as well. And the proceeds from those sales, as well as some of the trims that we did across the portfolio, we were trimming our position in Alphabet and in Facebook and in Visa and in Estee Lauder. Though we didn't exit those positions, we were reducing the exposure to all four of those businesses, plus those two businesses that we exited that resulted in that increase in cash. But we also took a new position in Tencent, the leading, or one of the leading digital platforms in China, somewhat similar to Alibaba in terms of its dominance across the digital ecosystem, but plays in different parts of the digital ecosystem compared to Alibaba. So we exited two positions, we trimmed a number of the more cyclical positions, and then we entered Tencent, and we've got a pretty meaningful cash position today, which we'll look to redeploy and take advantage of opportunities as they arise through this cycle.
Yep. And what's your thoughts? Obviously, gone a little bit more defensive. What do you think the trigger might be? We've had a nice bit of a rebound in the markets, which may be unwarranted. Do you think the markets have been a bit optimistic about the recovery, or the revenues and profitability is not going to dip quite as low as what you think they might?
It's not entirely surprising. I just think maybe the market's factoring a slightly different shape cycle to the one that we have in mind, but it's not nonsensical. The market move, it seems to be, who really knows what's driven the market.
Yes.
But best guess, it would sort of be a consideration that we've seen relatively positive developments in health outcomes. Curves have flattened and active case numbers are declining. All else equal, that's positive because it allows economies to reopen. But there are other risks of second waves and all those things. And the market may have also responded to just the degree of policy intervention, particularly the monetary policy intervention, and the liquidity injections and the support provided by a number of central banks, but particularly the Fed, and some of the actions they've been willing to take. And, it might be those things, it might be a few other things as well. And the market seems to be pricing something closer to a V-shaped cycle here, as best as we can tell. And I just sort of mentioned that our view is probably a little more cautious than that. We recognise there might be economies, and pleasingly Australia might be one of them, that experiences something closer to a V-shaped cycle.
Yes.
Australia, New Zealand, maybe China would be in that bucket as well. But we think most advanced economies, Western Europe, North America, other parts of developed Asia, they may face something closer to a U-shaped cycle or something a bit deeper and a bit more prolonged than that V-shaped cycle that markets appear to be pricing. So I just think we've got a slightly more cautious view in terms of the duration of this cycle and potentially the depth of this cycle than what seems to be priced into markets, as best as we can tell. But Rob, as you know, we don't spend too much time thinking about where markets are. We just want to find these wonderful businesses. And sometimes, and when they are available at, a great discount to what we think a conservative estimate of fair value is, that's when we tend to invest in those businesses. And we don't see a lot of those type of opportunities at the moment, given the macro scenario that we're thinking about and how that will impact the short-term, medium-term prospects for a lot of the companies that we invest in and that we follow. They don't seem to be particularly attractively priced at the moment.
Right. Chris, do you think that obviously a lot of the central banks, the governments around the world have obviously low interest rates have got lower in most parts, and there's been a lot of stimulus, that this is setting a foundation, if we're looking 5 years out from now, that it is setting the global economy, although things might look different and business might be done a little bit differently to what it was, but it is setting the foundation for strong future growth?
Well, it's a good question, because you could take either side of that argument. I think the policy intervention, I think, seems to have placed a pretty solid floor in terms of how bad this cycle could have been in the absence of that policy. We've seen very meaningful fiscal policy, particularly out of North America. And again, the actions that the Fed has taken has really ensured this health crisis didn't cascade into an economic crisis and then into a financial systems crisis. So that the actions the Fed have taken have sort of provided a bit of floor in terms of this cycle as well. But we still think, just given the shock that the economic system has experienced here, we're all seeing these unemployment numbers, the bankruptcies, the layoffs, the delinquencies and the loan data. There's just a lot of pain, economic pain out there at the moment. We don't think that passes too quickly. And therefore, you've just got a period now where things are probably going to be challenging for a little while, which means there is probably still a further role for policy to play, not just to provide that support to the economy today, but actually to create some positive stimulus and to help catalyze that recovery at some point. And, we just need to keep in mind that further stimulus, those further fiscal injections into the economy, could become more and more challenged, because we're now talking about trillions and trillions of dollars of deficits and increased debt levels. And there's no guarantee that those future packages will be enacted. Already we're seeing some frictions in Congress in the United States at the moment in terms of getting the third package through. Of course, we've got the election later this year, so there's no guarantees around those future packages, but we think they will play an important role. And there's a question mark there. But then we need to think through, well, even if they do get those fiscal packages through and that can provide the support and the stimulus to the economy, there will still be a point at which governments most likely will need to repair their balance sheets. We're going to have very high deficit levels, very high debt levels on the other side of this crisis. And that might be the most appropriate thing to get through this output gap. But on the other side of that output gap, repairing government balance sheets could mean higher tax burdens or reductions in government expenditures, and that causes a headwind to the economic cycle. So there are puts and takes in both the short term and the medium term. The point you made around the interest rates, long-term interest rates being set almost at these very low levels because of the Fed policies, that's a very important point. That's sort of what I was hinting at a little earlier in terms of one of the reasons why markets might have rallied as strong as they have in the last two months, because that lower for longer long-term interest rate, all else equal, that's very supportive to asset values and equity values. And if markets are pricing that roughly correctly, that should result in higher intrinsic values and therefore higher share prices through the cycle. So I'd say incrementally, we've got greater conviction that we're in this sort of lower for longer interest rate environment at the moment. But again, we sort of don't know what the costs, the medium to long-term costs from some of this policy will be. We're seeing huge amounts of quantitative easing going on at the moment. At what point does that become inflationary? It didn't happen last cycle. Could it happen this cycle? And therefore, will there potentially be upward pressure on long-term interest rates if central bankers feel they need to respond to those inflationary pressures by increasing interest rates? That's a very important uncertainty out there at the moment. So I just sort of say across different time periods, short-term, medium, long-term, there are both puts and takes in terms of the fiscal policy and the monetary policy that you need to think through.
Yes, fantastic. Thanks, Chris. Getting back to the fund, obviously, LVMH and Yum Brands have got a very strong China focus. Obviously out, but brought in Tencent, which is wholly owned and trades within China. I read some very interesting stats on one of your reports on Tencent on daily active users within their app, their ecosystems. Could you, obviously probably a bit of a favourite stock within the portfolio, Chris? Can you give us a little bit more detail around, I suppose, the usage within China within their apps and their businesses?
Yeah, it's a pretty special business that they've built over there. They kind of call it a super app, which we don't really have many Western equivalents for. I think that's what Facebook is ultimately trying to create. And even a business like Uber, I think is trying to sort of copy that model of, they start with ride sharing and then they offer delivery and food delivery, and just sort of, if you can create that ecosystem of engagement with your users, you can start adding additional services. And that's exactly what Tencent has done with WeChat for many, many years now. And a good way of Australians to think about WeChat, which has 1.2 billion users in China, which is breathtaking in a country of 1.4 billion people. It's kind of like a bit like a Facebook in the sense that it's a messaging platform and a social network platform. And that's what brings users into the WeChat app every day. And then they effectively use that app to funnel those users across a bunch of their other different services. It could be online gaming, it could be their digital media, video and entertainment businesses, it could be their digital payments businesses. They've now got sort of an enterprise facing mini programs effectively where businesses can create storefronts effectively within WeChat. And users can purchase goods within the WeChat app from those businesses directly. So there's a whole ecosystem that is developed within WeChat, and there's just an enormous amount of engagement. It's become a very central part of, as we mentioned, 1.2 billion Chinese citizens' digital lives.
Yes, yep. And that shopfront side, obviously, Facebook have just come out and announced a similar strategy where you can set up a shop within the Facebook apps. I think the 4 apps that they run. Facebook is obviously a business you'd know well as well from an investment point of view. Is that you're quite optimistic as well? optimistic about Tencent, but Facebook as well, and their strategies, Chris?
Yes is the simple answer. I mean, it's very early days. They've just announced this, but what they're trying to recreate is quite similar to what Tencent has built within WeChat.
Right.
And that's just recognizing that, again, Facebook across its suite of apps, of course, it's got Facebook and Instagram, WhatsApp and Messenger. It's about a third of humanity that interacts with those apps on a sort of daily or monthly basis. So there's a huge amount of engagement and usage of those apps, again, which Facebook can potentially funnel to certain businesses that have business accounts on Facebook or on Instagram. And if, we are users of the Facebook app or the Instagram app, and we're on the Nike Facebook page or Instagram page, for example, they will have the ability to then transact, not just, view the goods, but actually to purchase the goods from that company. So that's really exciting.
Yes.
It's obviously a very competitive space. Amazon is very dominant in a lot of the markets where Facebook is well established. So it's a long road ahead of them, but they are very well placed to have a good crack at it, just given they have a user base of a couple of billion people around the world. And that's what they're trying to recreate is very similar to that Tencent model.
Right. And obviously the shop fronts within Facebook, reading the other day that the shops are free for businesses to use, but it's all about keeping the consumers, the Facebook users, within the applications, within the environment, which ultimately leads on to more advertising. That's I suppose the ultimate goal, Chris?
Yeah, it will be a driver of their advertising business. There's probably some ancillary benefits as well, but if you sort of recognize that if you're a business with a business account on Facebook and there's a couple of billion people on the other side of the network that are using Facebook, you want to have your brand or your business stand out and attract those users, and so you're going to advertise on Facebook. And so it, in a couple of ways, it just allows for more advertising on the platform, but it's also very valuable to Facebook because they will be able to effectively close the loop between the users and the businesses and see which advertising works and where the conversion is, where the transactions actually take place, which allows Facebook to learn more and more about its users, not just what ads they're looking at, but actually the purchases they're making, which allows them to further develop the profiling and the targeting for the marketing that they will serve those users, which allows them to charge the advertisers more for those ads because they're likely to have higher return on investment.
Yep, fantastic. Just looking at Microsoft and Google, obviously Google Classroom and Microsoft Office 365 and Teams, which we're recording on at the moment, have all of a sudden have these big tech businesses become quite defensive in terms of the style of business they are, that in terms user numbers going up and then locking us in because we become reliant?
That's part of the attraction to them. Yep. They do offer, frankly, they offer some pretty amazing services, and that creates that engagement and frequency of engagement. We're all using a bunch of Alphabet's products on a single day, whether it's search, it's maps, it's Gmail, it's calendar, it's the assistant, Facebook's suite of apps, Microsoft. It's hard to think, white collar folks like us, how we could do our jobs without, on a daily basis, using Outlook or PowerPoint or Word or Excel or now Teams, this wonderful app that frankly we didn't even know about until a few months ago. They do have very sticky products with high engagement, and that is, that creates that network effect and that switching cost that is quite common across each of those three businesses. We'd say Alibaba and Tencent are also quite similar in that model, and that's genuinely the core part of their moat. When we talk about the high quality businesses in our universe, the most important thing we think about is that sustainable competitive advantage or moat around those businesses. But I think, very much agree with what you're saying as well, Rob, is not only do these businesses have that moat, they also are well positioned in terms of these sort of growing industries, whether it's cloud computing or digital payments, digital advertising. There will be cycles in each of those industries. Digital advertising is likely to experience the cycle here. That's one of the reasons we were trimming our positions in Alphabet and Facebook. But we expect those industries to recover and to really thrive over time and continue taking share of total advertising, or digital payments taking share of total payments. Those trends are the real long-term attraction. It's been pleasing and a little surprising how much the companies have benefited from this sort of isolation, shutdown period as well, particularly businesses like Microsoft, but also businesses like Alibaba and Tencent. I mean, they have been very important beneficiaries of these sort of digital trends and online trends in China through this coronavirus period.
Yeah. Chris, given as we're talking about the mega caps of the world, truly global businesses, and Microsoft, I think, is over about 1.4 trillion at the moment, last time I looked. I think for a lot of clients, there's always that feeling that, surely there's a ceiling to how big these businesses can get. And I'm sure we all thought that when the first business got to 100 billion or 500 billion and then a trillion, but they've then powered on again. There is no ceiling, and at the end of the day, the driver is growing profitability. How much more of the world is there for Google and Microsoft, and are they reinvesting heavily enough into other platforms and businesses to keep growing? Like, is there a top end? My firm belief is no, but
it's such a good question, and one we think about a lot. And at the end of the day, market cap, which you referenced, about 1.4 trillion market cap for Microsoft. Over time, that will sort of roughly triangulate with Microsoft's intrinsic value. And that will roughly be determined by its sort of earnings power and cash flow stream, free cash flows over time. And so what we really need to do is just sort of get back to those first principles and think about, how big can those cash flows and those earnings streams become for those companies. And you need to think about the profit pools in which Microsoft is playing to get a sense for whether they can continue compounding their earnings at 5, 10, 15 or 20%. And I think that's where it's so important, the work that our research team, our incredible team of analysts at Magellan does, spending all day, every day thinking about that very question. Can Microsoft, within the office productivity ecosystem, within the cloud computing ecosystem, within the PC operating software ecosystem, within the gaming ecosystem, all those parts are part of Microsoft's business. Then we think through, market growth rates for those industries, Microsoft's share of those industries over time, the margins associated with those businesses over time. I think the important part for a business like Microsoft is it's really early innings for some of the largest parts of that business, particularly cloud computing. The numbers there in terms of total addressable market, no one can precisely know, and we don't think we can either, but it's potentially in the trillions of dollars, that you could see massive enterprise IT budgets shift from on-premise to cloud in the years, but more likely the decades to come. This isn't going to happen quickly. It will happen year after year, gradually, probably for decades. But that a total addressable market, and recognizing that Microsoft's Azure business, Google's cloud platform, Amazon Web Services, the three big players, Western players in that cloud industry at the moment, there's still a tiny fraction of that total addressable market. So there is potentially still a very long-term runway ahead of these businesses, but you can only get comfort in that recognizing the industries in which they play. We wouldn't argue that Walmart, for example, at least its offline business, Walmart online will benefit from e-commerce trends, but Walmart offline is quite a mature business now. They can't go and double the number of stores they have in North America. They have saturated their addressable market, or they're close to saturating their addressable market, whereas the cloud computing industry is by no means close to saturated at the moment. And so I think it's just an important point that we really get into the weeds in terms of understanding the businesses and their industry exposures. And that's something we don't set out to be sort of trend investors, but we love finding those high quality businesses that operate in those industries with some sort of secular enduring growth tailwind behind them, whether it's cloud computing. Digital payments has been a very important one for us for a long period of time through Visa and MasterCard. The China consumer is a bit more of a recent one. We think there are, enduring long-term tailwinds behind particularly the sort of upper medium to aspirational consumer cohort in China that could play out, and we want to find high quality ways of accessing those businesses with those tailwinds. And we're always pretty deliberate around avoiding the opposite, not trying to find businesses, whether it's legacy offline retail or legacy media, where you're just constantly day after day fighting into that headwind. It's just a tough place to be.
Right. Chris, just obviously these are very high quality businesses, great sectors, great tailwinds pushing them with products that are near monopolies in their sector. Could you just touch on the balance sheet of Google and Microsoft? It's one that I focus on for my clients a lot. Can you just give an idea of the breadth of these balance sheets and the resources they've got at hand?
Yeah, it's staggering. So each of them, I'm just trying to think through the high conviction holdings. Starbucks has a little bit of debt on its balance sheet, but thinking through the rest of them, certainly true for Alphabet, Facebook, Alibaba, Tencent. Visa's got a tiny amount of debt, but most of them are all running very sizable net cash balance sheets.
Yep.
And that can be in the order of, for Alphabet, I think it's over $100 billion today of net cash.
Yep.
For Facebook, it's probably over $50 billion US in net cash.
Yep.
Alibaba is some sort of enormous number like that as well.
Fantastic.
And that provides many layers of comfort, but two important ones. Obviously, they're going to survive this period, just given that they're very profitable and cash generative to begin with. But then they have these enormous cash reserves. It just allows them to survive. There's complete peace of mind that these businesses will get to the other side of this particular crisis. But the second point, which is probably more important, is that it provides them enormous optionality through this downturn. If we get attractive consolidation opportunities where they could potentially acquire some businesses at really attractive valuations, or they can just outspend their less well-resourced peers through this downturn. Yep. All those things should allow them to emerge stronger on the other side of this. And that's, it's a real attraction to these businesses. And if you contrast that just with the sort of short-term concerns we had, as I mentioned, around Yum Brands, which resulted in the exit of that position, we could come back and invest in Yum Brands happily. There's no long-term concerns, but we just had some short-term concerns around that balance sheet. But there was no other position in the portfolio where we had similar concerns. And that's pretty true to our process. When, as I mentioned earlier, when we define business quality, economic moat is right at the heart of that. But we also do think about business risks and a few other things as well. But business risk, and particularly operating leverage and financial leverage very much informed by the balance sheet structure. And importantly, we always gravitate towards businesses with low business risk, and that tends to, in part, be reflected in having a really attractive balance sheet.
Right. Yeah, thanks, Chris. Great answer. You mentioned Starbucks at the start of that chat. Obviously, their China growth plans, how's that been affected of late? I think the stat was opening one new store every 15 hours in China, yep. And have done a deal with Alibaba when it comes to delivery of some of their obviously their coffees and other products. How's Starbucks been affected? Not from a share price point of view, it's down a bit like everything else, but I suppose operations, have they slowed down the rollout of new stores in China?
Yeah, certainly they've had a short-term impact to their business, as restaurants and cafes all around the world have. The vast majority of their stores in China were closed for a period of time. A vast majority of their stores in the United States were closed also for a period of time there. Yep. I think nearly all, if not all, of their stores in China have reopened now for at least a number of weeks. And I think the plan for Starbucks in the United States was to have sort of 80 to 90% of their US stores open at the start of May, and then close to 100% of the stores open pretty shortly thereafter. So yep. The recovery is progressing, but they are still down year on year in terms of same store sales. And that just speaks to the fact that they've had a number of stores closed, a lot of stores closed. In terms of the growth profile going forward, you're absolutely right. That they came into the year this year, talking about opening roughly 600 new units in China, which is about one every 15 hours. And impressively, notwithstanding everything that's gone on, they've cut that a little bit. It's still 500 new stores they're expecting to open in China this year, which is still over one a day.
Yep.
So, a sort of a marginal impact on their China openings this year. But I imagine it just defers and they open more, next year or the year after that. In no way do we think this challenges the long-term thesis for Starbucks in China. But it certainly has had we're not call it as we see it, it certainly has had a short-term, albeit we think temporary impact on their business in the last quarter. It will certainly have an impact this quarter as well. And potentially for a couple of quarters after that, things could be bumpy, just as stores reopen, but they'll be subject to different operating hours. They'll be subject to distancing requirements within the stores, probably less seating, the need for curbside pickup. They'll have to flex and adapt their model a little bit here. But at the end of the day, they've got a wonderful brand. They've got wonderful real estate still. None of that's changed. They've got a very effective and well-developed digital presence. That their app in the United States is used by, I think, roughly 18 million Americans. So that allows, online delivery, online pickup. So that it's still a very well-positioned business, but it is true that they've had a sort of short-term impact here.
Yep, and I think it might have been early. Was it 18 or 19 when I was in Hong Kong, down in a Starbucks store, just observing, I suppose the behaviours, and what sticks in my mind. Clearly, this was a lady that was probably mid-70s, holding out her phone to the, the cashier, obviously claiming back some sort of bonus for having the app, and that sort of digital just creates loyalty and habit, and so they clearly got that rolled out quite nicely across the globe. With obviously, when they opened a store in China, I heard some very impressive stats around, their return on, their cash return in year one under normal trading conditions. Can you give us a bit of feedback on their return they get from opening a new store?
It's roughly 80% year one cash return on investment, which is breathtaking, and just sort of speaks to the compounding machine that's available in their China operations in the years ahead. Capitalism being what it is, it will not remain at 80% forever. Competitors will come into that industry. There's no doubt about that. Incidentally, we should note that the audience may have seen the developments recently with Luckin Coffee. It got a lot of headlines. Their largest competitor in China, but listed in the United States, was found to be sort of fiddling with the numbers a little bit. And that business seems to have really suffered. I think they've lost some senior executives and potentially board members. So their largest competitor in China has got some real issues, which is a bit of a short-term free kick for Starbucks. But their business in China, the returns won't remain at 80% forever. More competitors will come into that industry. But even if returns were to halve just directionally from this level, that is still an incredible reinvestment opportunity for them. And we still think, coming back to the point we made earlier around Microsoft and the cloud addressable market, the addressable market for all coffee providers in China is still enormous. We think Starbucks is really well positioned to capture their fair share, but the market is big enough to support a number of different players, just as like it does in the United States. You've got Starbucks and Dunkin' and a bunch of other players there. There'll be more than just one competitor in China over time, but notwithstanding the more competitive nature over time, it's still an enormous market in which they can deploy a huge amount of capital, our clients' capital, given we're shareholders, at very attractive incremental returns.
Yeah, and it's not just the increasing rollout of new stores. It's the habits of the Chinese. They're obviously a tea drinking community population in the past, but so their consumption of coffee is extremely low compared to our habits.
Yeah, that's right, and they're very aware of that. I mean, obviously, it's not you don't walk into a Starbucks in China and see the same Western menu that you might see in Melbourne or in Sydney or in New York. So they've adapted the menu. Obviously, having more tea on the menu, different food menu. yeah, that they are also introducing Chinese citizens to the coffee habit, and it's not a new thing for them. Starbucks has been in China for 20 years now, so it's not unproven their ability to open stores. They've got roughly 4,000 stores there already. They've proved the model works. It's just a matter of now opening up more of those boxes all around the country.
Yes. Yep. Very good, Chris. Look, I'd probably just like to get back to the High Conviction Fund, your baby, and notice obviously there's daily buybacks. Can you, where Magellan, the fund, the trusted, the listed investment company that it is actively buying back its own units or own shares. Can you just, I suppose, give us a background of the buybacks and how that's very attractive for current holders? Yeah,
it's a good question, Rob. It is it's something we do within that listed investment trust structure. We've done it historically with the Magellan Global Trust, which has been on the ASX for a couple of years now. And since we listed the High Conviction Trust in October of last year, we've seen it trade at a premium to net asset value and at a discount to net asset value. And what we want to try and achieve through the few tools that we have available to us is to, have clients have a good investment outcome. We don't want it trading at a big premium, nor do we want it trading at a big discount to net asset value. And we can try and achieve that through frequent disclosure. And we provide an indicative NAV every 15 seconds. So investors should always know what that NAV is roughly worth at all times. But one of the other levers that you rightly identified is that buyback. And whenever we feel that the price relative to NAV is at some sort of meaningful discount, we'll just step into the market. The listed investment trust, the entity itself, will step into the market, use some of its cash just to buy back some of those units. And the intent is to try and have the price as close to NAV over the journey as we can facilitate. We're not trying to manipulate prices or anything like that. It's just we're just trying to signal through disclosure, through buybacks, that we're trying to create that good client outcome, having the price as close to NAV as possible over time.
And also buying it at a discount makes it an attractive investment in itself, Chris, that obviously you guys like just as much as some of the investment opportunities, because you are using the trust, the cash itself.
Yeah, that's right. I mean, it's a good point. We try and buy Microsoft and Alibaba and these wonderful businesses at a big discount to their intrinsic value. If we can add to that discount by buying the units in the trust which own these businesses with a margin of safety, just adds that additional layer of margin of safety and enhances the return prospects for those remaining units in the trust.
Yeah, the ownership of those units are not cancelled at all. They're held by the trust.
Yeah, that's right.
Yep, very good. Question I'll be keen to ask is, of the suite of awesome businesses that you've got within the High Conviction Trust, that 10 to 12 businesses, what are you most optimistic about? What's the one that really gets you quite excited?
I think at the moment it's probably Alibaba and it's probably Microsoft, and that's to be completely frank, Microsoft at the moment, the price reflects of a lot of good news and the prospects for that business. So it's not a complete bargain at the moment, but we do think it's at a discount to intrinsic value. But what I'm really speaking to there is just the inherent quality of so many parts of Microsoft's business and Alibaba's business. Both are incredibly well positioned within their industries, and they operate in these enormous industries that we were talking about earlier, that just provides conviction that there is a multi-year, if not multi-decade runway ahead of those businesses. And given their business models and given their competitive positions, the economics of that growth should be incredibly attractive and very rewarding for shareholders over time. So I think they're two businesses where, there is a real comfort in the short term because they have such wonderful positions. Their products are needed by their clients, their customers. We need to use Microsoft. Many of Microsoft customers need to use them. That's a wonderful place to be, and it provides that short-term resiliency in this challenging economic environment. Likewise with Alibaba's services across e-commerce and cloud computing in China, they are very resilient in the short term, but then they have this very attractive long-term growth runway ahead of them with fabulous economics along the way. So they are the sort of businesses, all going well, and subject to price. We would hope to be long-term owners of those businesses for, hopefully decades. They are the sort of businesses where we just would love to own them at meaningful position size and just allow them to compound year after year after year. And it won't be a straight line, of course. There'll be cycles along the way, and the share prices will also move up and down. But the underlying quality and fundamentals of those businesses should allow, based on what we know today and sort of judgments about the future, should allow for some very attractive long-term investment prospects from those businesses.
Just, I was going to wind up, but one more question in relation to Microsoft and the reliance. As you've already said, you've never seen Teams up until about a couple of months ago, and you think, well, gee, how good is this? And you'll probably use it for the rest of your life. The South Australian government just rolled Teams out to 42,000 healthcare workers in South Australia, and they did that within 1 week. And I know how reliant I've become on Office 365, and Teams is just part of that platform. One thing that obviously the growth runway, where they're getting new consumers and new clients all the time, but I often reflect on if Microsoft come to us and say, hey Rob, look, we're just going to increase your what you pay per month by 10 or 15%. I know what I'll have to do, and that is to suck it up and pay. So at any stage in recent times, have they looked to increase the price of what they charge people for these products yet, or are they waiting for people to get well entrenched?
Typically what we see is the latter, and it's not just Microsoft. It's whether you look at across so many of these digital platforms, and you absolutely made the right point calling these things platforms, particularly Teams, which we should come back to, because it is the case that Teams, which is just sort of an app, today's just some software, it could actually become its own platform in its own right, where more and more third-party apps and first-party apps are added to Teams to just increase the stickiness and the platform-like nature of Teams. But what you tend to find in this digital economy is that typically the businesses go for engagement first. They go for usage, they go for number of users, they go for engagement, and then they look to monetize at some point. And for some typically consumer-facing businesses, that monetization comes through advertising, though it can also come through subscriptions like Netflix and Spotify. But then on the enterprise side, it's interesting. There's examples on both sides. There are parts of the enterprise ecosystem where you've actually seen prices fall over time, and cloud computing has certainly been part of that. Core parts of cloud computing, like just storage on servers and things like that, that has been falling in price over time. It's been more than offset by the huge increase in usage of those services. But then, yes, there's also parts of the enterprise ecosystem where you do see pretty regular increases in prices once they know they've got you. Once you're stuck in the ecosystem and you can't get out, which is not too dissimilar from the Apple model either. Yes. Every new iPhone that comes out is a pretty meaningful increase to the last model. You see elements of that within the enterprise space also. Yeah,
fantastic. Well, very good. Thank you very much for joining us, Chris. I appreciate your time, and I'll let you get back to your family.
Pleasure, Rob. Thanks for having us.
No worries at all. Thank you very much.